Hey everyone, welcome again to the latest installment of The Way It Is. I'm your host, Luca with Remax Service First Realty, and I am pleased to have with me David Sutherland, mortgage broker with Kingston Mortgage Solutions here in Kingston. David was kind enough to fill in last minute, but timely because obviously, David, we're on the heels of yet another rate increase from the Bank of Canada. So first, welcome, and thank you for being here.
Yeah, thank you, Luca. It's my pleasure to be here, and I'm looking forward to our discussions.
Yeah, so obviously, you're a mortgage broker. You're in it every day. What I guess what's the initial fallout, I guess, in terms of what you've seen since yesterday's announcement?
Right. So I think to take a step back, I think it's important to understand what we've just come through as a country. March of 2020, I was sitting here by myself, wondering what would be. And at that time, Bank of Canada had decided to encourage people to continue to spend and to keep the economy going during a very difficult time. They reduced prime rate down to 2.45%. Since that time, we've emerged from that dark and difficult time in the Canadian economy to some extent. Who knows the future? But in any event, right now things are starting to come back to more normal levels on many fronts in the economy. And as a result, we have seen a lot of excess savings, government stimulus, and various other monies that have been injected into the economy, which has done a couple things. One is that it's stimulated spending tremendously. So people out there know that they may have invested in that rental property, bought a cottage, purchased a new vehicle, done home renovations, various things that we have seen people do with some surplus of cash that has been come available during this time. And the other thing too is that people's house values have gone up tremendously as well. And so as people had dreamed about future plans and what they may do, they realized that there was now a new store of equity available to them. So all of that said, it's caused the Bank of Canada to realize that with excess money and a shortage of goods because of various factors in our economy with supply chain issues, et cetera, we have found ourselves now with inflation rising astronomically. Canada has always enjoyed a relatively low inflation rate, especially in the last number of years. But right now it was running over 8%. Luckily, it's pulled back from that. July's numbers are 7.6%, and a big part of that basket that measures inflation in our economy is gasoline prices, with some changes in that regard. We've seen that inflation number come down a bit. 7.6% now is the new July number. That said, it's too high, and people, of course, are feeling this in every regard, shopping and groceries and various other things, where it's hit people. And maybe the question you have is particularly for mortgage holders. It's hit them with the variable rate mortgages. That's not to say that the fixed rates have been unscathed during this time. They haven't. They've certainly gone up as well. But variable rate mortgage holders have seen an increase, particularly with a 5-fold increase in the Bank of Canada overnight rate, which translates generally into a lockstep increase in prime. So Since March, we've seen 5 increases. The next Bank of Canada meeting is scheduled for the 26th of October, and we widely expect there could be a further adjustment. Governor Macklin will, obviously determine that at that time, but at this point, it's expected that we could see another adjustment. So that said, prime today is 5.45% versus 6 months ago, it was 2.45%. So 3% increase has had a tangible effect, not only in terms of people's existing arrangements, but also for those that are considering perhaps purchasing. So there's no question. And I think people are concerned. I think people are wondering what's the way forward? What can I do? What should I do? And this is where I think as people in the financial business, which I've been in for 29 years, I think
Right.
this is where it behooves us to reach out to our clients and say, listen, here's what you need to know. Here's what you need to consider. And there's some changes you may have to make, and a lot of it, Luca, I'll be honest, is I think getting back to fundamentals. I've been a certified financial planner as well since 1999. And I always encourage people, to take an inventory, of your household budget, see where you stand. Where can I make adjustments? Is it perhaps altering my cable arrangement, or perhaps one less thing on my cell phone, or perhaps one less dinner out, etc. Make those adjustments that are necessary during this time. And that's what the Bank of Canada is trying to get people to do. Look at their spending, determine where they can have some pulling back so that we can get this inflation number down. If people keep doing exactly what they're doing and make no changes, then it won't happen by osmosis. It will happen by the governor continuing to raise rates until people finally get the answer that they need to make some changes. So,
well, and not to cut you off, but the unfortunate reality of what you just said is people don't react well to those kinds of changes because they get spoiled very quickly with all of their amenities and life's pleasures, or data and streaming services and what have you. But I guess the other bigger maybe economic factor is that we may be one time potentially, and certainly offer your opinion. We may be at one small window in time where incomes may not necessarily be keeping up with rising costs, right? I mean, there was, I remember, I've done this for 35 years, and, it was always that, you can get a fixed mortgage and your payment stays steady and your income will climb. And then so the gap becomes bigger. I dare say we're in a situation where it's that gap is certainly closed a great deal.
No, I completely agree. I will say that, back in January of 2018, the federal government introduced a stress test. And the stress test was designed to sober people up a little bit to the realities that this concessionary pricing is not going to last forever. I've seen it up and down. I was reflecting the other day with someone, not to sound old, but when my wife and I bought our first home in 1988, I was transferred to Perth at that time. And we bought a little place for $51,000, and we got a 2-year term at the Royal Bank for 14.75%. And and I had to take a second job. I had to take a second job on the weekends to keep that going. We were just a young couple getting started, and then we got transferred to Kingston, and I had 11%. And then when my mortgage came up and renewed, the manager said, look, he says, I got a special here. He said 8.75% if you're interested. And I thought I'd gone to heaven at that time, 8.75, And so there's no question that these rates are higher than they have been for the last couple of years. There's no question about that. But I think people have to understand that there are cycles in our economy where these things, sometimes it's external forces we can't control. It could be things like what's happening in Eastern Europe right now, as an example.
Correct.
It could be other things in our economy that are having an effect, or even our friends in the U.S. We all remember 2008. And obviously, at that time, Kingston's fortunate. We have a very insulated economy. About half of everybody that works in Kingston worked for some level of government, whether provincial, federal, municipal, or county.
That's right.
So there's a tremendous amount of very good paying, solid, steady jobs in Kingston, but not everyone is in that boat. And so I think that the stress test was designed to make people realize, listen, you have to soberly consider what will be the situation if rates increase. And of course, people, it might be a small, but look at where we are today. And so, what's happened is now that people were shut out of the market because of the stress test, because now we have to qualify you at a higher rate than you would typically be paying. Well, now the stress test has been largely completely negated by these rates, because we had to charge you or qualify you at the contract rate plus 2% or the stress test, whichever is greater. Well, everything exceeds the stress test now. So I think that what we've realized is that people that didn't get in the market, perhaps that was a good thing at that time, because now they would have really been very, very tight had they been able to get through at the contract rate. So, it's one of those things. It's not going to last forever. But right now, there's some adjustments required for sure.
So a couple of questions. First one that I'll ask though, because, there's been increases not only in the fixed mortgage rates, but obviously the variable rates. So, and there's always been that age old debate, fixed versus variable. What do I do? There has to be people, I'm sure, throughout these 5 increases, and especially again, and then maybe with the specter of another one in October, is this the time when the naysayers lock in, or do you ride it out? I mean, obviously neither of us have had a crystal ball. If we would, we'd be doing this podcast somewhere really sunny with palm trees in the background and stuff. But what decisions can be made now, I guess, or, if you can offer some insight there. So.
Right. So I would say that, there was a reason why a person selected a variable rate mortgage. And, for those that did a few years ago, it was probably a very wise thing to do because they've enjoyed a very concessionary rate for a long time. And so that has built some momentum in terms of reducing their amortization by having that variable rate. The other reason they could have selected a variable rate, especially a few years ago, was they perhaps said to myself, as an example, clients of mine may say, well, we may sell this property. We're not 100% sure. So if we do, we'd like the option of getting out of the mortgage without a large interest rate differential penalty. And so the variable affords people to exit with 3 months interest rather than a very large penalty. And some lenders' IRD penalties are very, very steep. The charter banks typically will provide a deep discount at the time of acceptance, but they calculate their penalties based on a bulletin rate, which is a rate that they would never charge anyone particularly, but it's a higher rate. So when they make their calculations, the IRD penalty is much higher, whereas other lenders, and believe me, I'm an ex-banker, so I'm pouring no cold water. Our banker friends are very important to us. It's a function of being able to slot people into the right place based on what they say. And I think this is where for us, it's not order taking. If this business becomes strictly commoditized, I'll retire, because that's not what it's about to me. It's about listening to people, but realizing that they may not know. Many people come in and the first thing that they say is, what's your best rate on a 5-year? And I say, well, first of all, tell me what you're doing. Are you building a house?
Yeah.
Are you, what is it you're doing? So for me, it's important to do the whole planning piece. Some people want to call 1-800 and do it like that. That is not what I personally offer. In our firm, and I'm the principal broker here, so I'll speak for us. We don't offer that sort of order taking. We think it's important that we really put people into the right product, the right solution for them and their family at the time, building some upside in the future. So for the variable, it may have been, we want the lowest rate possible because our cash flow is of such a nature. We want the lowest rate, or we want to be able to sell the property and have a low exit penalty when we do that. The other thing that's come up, and this is interesting, is that young people that have really been impacted by the stress test may have said, now look, I've been working very hard to get my budget in line and pay off all my debts so that I can qualify for a mortgage as a first-time home buyer. But what we found was, because there was a disparity between fixed and variable, at a fixed rate +2, they couldn't qualify. But at a variable rate +2, they could. And sometimes there was 75, 100 basis points difference between the two. And when they're a new buyer, they generally are insured by one of the mortgage insurers. And so it's very prescribed. We have no latitude. And, when I started doing this years ago, I used to ask people, well, who's your mom and dad? I know them, for good risks, etc. Now it's very prescribed, especially on the insured deals. So in order to shoehorn people into a deal, sometimes we have to say, we have to accept a variable now. Otherwise you don't qualify. But then we give them the options. And, almost all lenders, I don't want to say all, but almost all lenders would provide that you can move from a variable to a fixed with no cost. But you must select a new term that's at least equal to what you have left on the variable. So many people are considering that. The problem with that is, up until yesterday, was there was still a nice spread between, not as much as it was, but there's still a nice spread between the variable and fixed rates. Now that's almost been completely negated. So now they're almost the same. So again, it takes some planning to determine what is the right thing for me. I have some general advice, but I think specifically people wanted to speak to their mortgage person to say, what should I do in my circumstances? How much do I owe? What is the remaining term? What rate do I have currently? Many people say, well, I'd like to break my mortgage and do something. I say, well, you've got 2.89 right now.
Right.
I move you to 5.34. The penalty is going to be substantial. And you have to accept. So, sometimes you have to sort of say, what's the right thing? So it takes some planning. And I would also say, I don't want to sound like father knows best. I have 4 daughters, and they've heard this before. But, sometimes people say, well, I'm fixated on the mortgage rate, and people should be concerned about it because there have been some increases. But I'm carrying $30,000 on a line of credit at Prime Plus 4, or I have 3 credit cards at 22%. And I'm telling people, honestly, if cash flow is the issue, what I would do is focus on those high interest debts first, pay them down as much as you possibly can, and or consider consolidating them to your mortgage. Even with a higher mortgage rate, it could potentially be cheaper than you're paying on these other things, right? And if someone might say out there, well, look, I don't have any debt. All I have is my mortgage. Well, then what I'd recommend is say, can we find some extra money to take advantage of the prepayment options that are in our mortgage? So for an example, many of the lenders we represent, they offer a 20% increase in the principal and interest payment each year, or a lump sum payment. So is there an income tax refund coming in? Put it on the mortgage. It goes right to the principal. Mortgage rates are the interest is calculated every single day and generally compounded either monthly or semi-annually, depending on the type of mortgage. By putting a lump sum payment on, you're paying interest on less money, which means if there's a problem with the amortization because of rising interest rates, you can get it back on track by making a lump sum payment. What's going to happen is that people that have very, very low and concessionary variable rates that are in a type of mortgage that does not change with prime. Some lenders send a letter out to say, prime's gone up, your payment's increasing $47. Other lenders don't make any adjustment at all. What happens is you start paying less principal, more interest, and then all of a sudden you get to the point where they say, you cannot meet your obligations under this amortization schedule. You have to make an increase in your payment. And they call it a trigger point. So what happens is, every situation is different, but there comes a point where rates have increased so much that your payment will no longer cover sufficient principal and interest to respect the contract. So they're going to say you have to make an adjustment. So I always tell people, better you control it than they control it. So why not say today, let me explore options with my mortgage person. I'm doing this with my own clients and saying, should I potentially increase my payment, even 5%, 10%? It isn't one and done. You can, generally speaking, you can increase it by 5 today, but in 6 months, another 5, whatever. But many lenders offer 10, 15, 20% increase plus the lump sum. Now, the little thing you can do too, what I used to do is I go in my amortization schedule, and if there was $118 left at the end of the next payment, I'd make a $118 lump sum, so it's always 0, 0, 0 on my amortization. So I always knew every 2 weeks or every month, it was always going to be coming down a set amount of money, right? So I think you have to get into something that works for your household, that works for your budget. And if your budget's tight, then I would dare say, make that budget, see all your ins and outs, it's not difficult, take a piece of paper, draw a line in the middle. Here's everything coming in. Here's everything going out. What can I adjust? For an example, I phoned my car insurance recently, and they said, are you an alumni of any university or college? I said, yes, I am. They said, oh, well, just by being an alumni, you get I think it was about a 20% decrease in my premium. One phone call, and I said, about $40 a month. One phone call. So, do you really need that extra thing or this extra service? And then you make an adjustment, say, let's put that toward the mortgage. So our cash flow is the same, but we're paying that mortgage down more rapidly. So
excellent points, and I'm going to guess that trigger point is buried somewhere in the fine print of your standard mortgage charges when someone signs their mortgage, because that's as long as I've done that, that's the first I'm hearing of that. So that's excellent insight. So you touched on it. So let's segue right into right now. What are current mortgage rates? So based on the retail side. So what is a 5-year fixed mortgage, and what is that variable rate now in terms of the actual numbers? What does that look like?
So let me explain just a little bit first. So, when I was in the bank, we had one product, and that was it. It was one. When I say one product, I mean one type of mortgage. As brokers, we represent over 60 different lenders, and some of them offer special insured rates. In other words, mortgages that are less than 20% down, i.e. CMHC or Sagen or Canada Guarantee insured. Then we have insurable, which means they meet the criteria of the insurer, but they're not insured, but they get a insurable response from the lender, from the insurer on that product. Or there's conventional. So there's 3 different types. So right now, I checked this morning as an example, one of our good lenders, they were offering on an insured mortgage prime minus 90, prime minus 0.9. Which would put that mortgage now at 4.55%. Okay. Other lenders are somewhat higher than that. At certain times, certain lenders, price themselves in or out of the markets depending on, what their situation is. So on an insured mortgage on a variable, you're looking at about 4.55%. Which would be 4.55, prime minus 90. The fixed mortgage on that same lender, insured, is actually 4.59%.
Wow.
So it's virtually identical. Yeah. So some of the banks are a little higher. They tend not to discount during these times as much as other lenders. A lot of that's to do with market share and size and scope and how they raise their money versus a lot of lenders we deal with as chartered banks. They raise their money from depositors and in the bond market, et cetera, whereas other ones have investors in the back end which put money in and they require a certain premium, but they discount rates to get volume, right? So the consumer's the beneficiary of that, right? So our job is to understand what's the best product. Is it fixed as a variable? What's the best one? And then try to slot people in to that, right?
Now, you're of a demographic similar to me, where, and I've got lots of clients that, they're old school and they're saying, I have conversations all the time. They say, oh my goodness, there's going to be a lot of houses coming up for sale because when these mortgages that were signed 3 and 4 years ago or 5 years ago come up for renewal, these people aren't going to qualify. And, getting back to your, initial comments about the stress test and everything else, because I'm sure there's people that were locked in 5-year money at 1.99 or 2.8 or 2 whatever and stuff. What's some predictions for that situation or for those potential situations?
Yeah, here's the beautiful thing about the Canadian economy is that, and particularly in the lending game, there's 4 reasons why a lender will foreclose. A, you don't pay. B, you don't pay your taxes. C, you cancel your fire insurance. D, you tear the house down. Okay. Beyond that, you have what's called quiet enjoyment. So in other words, if you make your payments, you keep your property taxes paid, you don't cancel your fire insurance, having the lender as the first loss payee, and you don't tear the house down, then you have a right to renew your mortgage. Now, private lenders don't always afford that right automatically, but I'm talking about mainline lenders. You have a right to renew your mortgage. There's no qualification criteria on renewal. So if a person said, I'm worried about, my renewal, they can always renew. Okay. Now, what some of them are doing is they're saying, and in Canada, it's very traditional. A 5-year mortgage is what people generally take. But I have a lot of clients right now that are saying, well, what about a 1 or a 2-year? And a 1 year, probably, in my opinion, is a little short, but a 2-year is of such a time frame that it gives people the chance to see what's going to happen. And if there's a reduction, then in 2 years' time, they can take advantage of that. If there isn't, then they have been able to maintain a somewhat of a steady rate for those 2 years. So it's more of a wait and see approach. Nothing wrong with the 2 year. Many clients are asking about that sort of thing. So I think it's important, again, to have that discussion. But if you're going to just renew, your lender will renew. The only time you have to qualify is if you're going to switch your mortgage. Say, I don't like lender X, I want to go to lender Y. then we have to requalify you as a brand new contract. Although, generally speaking, we have those discussions ahead of time. And if there's any, recent job change or any bad news or impaired credit or what have you, then we tell people, probably better off just to renew, right?
Yeah. Yep.
The other thing I would say is that, and this is something we're doing somewhat more of it now, but many people come in and say, well, I have some debt and, and I was laid off for a period of time and I have a little bit of bruised credit, but I have a very good rate on my existing mortgage and I don't want to upset that. So what we're suggesting is we can do sometimes, in some cases, a small second behind their first to preserve that low interest rate mortgage, to not upset that, clean up whatever issue is there, and then dovetail the maturities, hopefully, so that at the end of it, you can put them together. Seconds are, used to be years ago, they were predatory rate and stuff. Actually, I don't want to name any names of lenders per se, but one of our really good, popular, well-known lenders actually offers a second at A rates, no fee, etc., behind their sort of sister companies. So there's things that can be done. There's other lenders that are higher rate and fee, but we often say, if you're Revenue Canada and you want to do something, or I'm 3 months behind on X, or I have another issue, whatever. Sometimes it's not about the rate; it's about the solution. And I tell people, our job is not to set you up for failure, but success. And one of the things we can do is get you out of the soup, keep your credit rating, etc. And this is where it's not cut and dry. When I started lending years ago, it was pretty much pay stop, job letter, house in a subdivision. It was pretty easy.
Yeah. People's
lives today are different, more complicated. There's blended families, there's part-time work, there's self-employment, there's contract, there's term. There's different situations that are not straightforward. Our job is to try to understand that, get all the information up front so we have a full file, and then place the business where it makes the most sense, recognizing that we want to give people options for the future and have them understand dynamically that we want to help you, not hurt you. So the whole idea is to put the right thing in place. So I think that's kind of one of the things that people can consider. But renewal, definitely, you can definitely do that if they're purchasing. And this is something that would be near and dear to your heart, Luca, because you're in the real estate. And my father was a real estate broker. He kept his license until he was 79 years old. So it's in our family a long time. But, house prices have started to come down. We've seen it. You've seen it firsthand. So I did some quick numbers for a client recently, and in light of some of these changes, and I said a $350,000 mortgage, which is, some are larger, some are smaller, but that's an average amount. $350,000 yesterday on a variable would have been about $1,803 a month. Today it'd be about $1,946 for the street mortgage, $143 a month difference. Okay. However, if that house has come down and you now need $25,000 less on that mortgage because the house price has come down, guess what? At $325, you're back to about $1,806. So so even though the rate's gone up, the monthly payment is not changed.
Yeah, and yeah, I mean, I guess I'm never a fan of saying prices are dropping, just because I think for me the context is that the values certainly aren't exceeding where they were in the beginning of the year in the full freneticism of the pandemic, which I'm sure you placed mortgages during that time when people, when people were overbidding, were paying over the asking and I mean, have prices stabilized? 100%. I mean, my always backstop to that is that the values are still the highest they've ever been. Period. From where we've come, but no, you're absolutely right. The house that, if this buyer is qualified, the house that they were looking at in January was out of reach. Now it's certainly within their reach if they're qualified. There's no question about that. And that's an excellent and a valid point. And I guess the other thing I was going to say, going back to when the conversation started, is given your history of when you first purchased a home, I mean, when I started, which was the end of 88, start of 89, the average 5-year money in Kingston was 12%. And I had clients that were absolutely ecstatic when they got 11 and 3/4 and,
Right.
and 11%. So, and even up until, I mean, I'd have to go back and check, I guess, historical records, but even less than 10 years ago, 5-year money, now you're saying 4.59. was over 5% or maybe even pushing 6% in certain cases and stuff like that. So we're certainly, you know what I'm saying? It's all relative, and people have to put things into perspective and into context too, right? I mean,
no, for sure. The sky is not falling, but I think people need to hear the governor very carefully and very clearly that we need to make some adjustments. We can't carry on doing exactly what we're doing and have no changes and not see this impact carry on. So I think if people do get that message, and start to rein in the spending, I think you will see, and there's some other external forces that will, impact that as well. But I think as Canadians, we just need to tighten our belts. I remember 2008, prime was 5.5 in January of 2008. We never saw a decrease in business, but we also at that time, I think people, had been not accustomed to such low rates. There was a period of time for, I think, about 7 straight years where prime rate never changed once. In fact, I think it ran for 3% for a long time. It dipped, I think, just to 2.85 shortly, and then during COVID dropped down to 2.45. So those are unprecedented rates, for no question. I don't know what's full stop period, full disclosure. I don't know what's going to happen. I do know that at the end of October, the governor will make a determination. But I think, pundits and other people that I listen to have suggested there could be another increase. But will that be the end? I think it'll depend on what people do, right? So.
Yeah. And I guess, you know what, I'm looking at the time, and I don't want to keep you because I appreciate you having done this to begin with, but we'll end on, I guess, the bigger picture, and not to obviously hold you to a forecast, but I guess my concern with what Macklin's doing is, even if, let's say, August numbers come out and inflation drops to let's say 7.2 or 7, or even maybe it drops below 7. And I don't disagree with you. A big chunk of that is the fact that fuel prices or energy costs have dropped. And yet I saw a snippet on a feed the other day saying that OPEC's going to reduce the amount of barrels per day by 100,000. So who knows where gas prices may go, right, if that happens. So, but there's going to be a time where I just don't know if getting back to 2 and 3%, which is the ideal goal, is conceivable, unless he, you know what I'm saying? There's got to be a line that he can't cross. Is there? I mean, I'm happy to hear your comments on that, I suppose.
Yeah, I think I will say, somewhat in defense of the Bank of Canada, is that, they do adjust their CPI number for gas prices. Their adjusted number, I think, excluding gasoline from CPI is, I think, 5.5. So that's a little better than 7.6. But, the governor has said it's a long way from 2%, which is their goal. And so it will largely depend on what happens. There's, as I say, there's some external things that need to get regularized, in our own country, but around the world. We can't forget, our friends south of us are going through the very same thing. Governor Powell our Chairman Powell has indicated there's some pain in the future, and and so these are not. This is not unprecedented, but it's also not enjoyable to go through. So I think people need to be serious, sit down as a family, make a budget, get their finances on track, look at where they can cut, make any payments they can, stay out of debt. I do think that in time we will see these rates come back down. It's happened. If you look at any charting on this, you will see that there are periods of increase and there's periods of decrease, and a lot of times they can turn fairly quickly. But I do think we'll get back to more regular levels. This is not sustainable, and the government won't pursue a policy of high inflation. I think it'll help us in the long term, but today it hurts, and I understand that. Yeah. So, I think this is where you want to reach out, and I think where people in my business need to be reaching out and talking to their clients. I understand you have some concerns. Here's what we can do to help. And I think that that's what really distinguishes us from order taking and from actually helping people work through these things. And I know, and I hope I haven't sounded vague or cagey in any of these answers, because all these things are interrelated. There's so many things that are so related, and so you know, to fixate on just the mortgage, and which is my end, but that's what I do. But you know, there's so much more. So I think we need to take it all into account. But there's strategies that people can do. I would just say again, work on paying down that mortgage, stay out of debt. You know, exercise your prepayment options. Talk to someone about, can we do something now? Does it make sense? Crunch some numbers, and we try to, you know, set you up for success in the future, leaving you some flexibility as well, right? So.
Yeah, no, and you know what? Well, that's a great way to end it on a note of optimism, and certainly some wise sage words of economic prudism, I guess, if you will. So prudence, rather. So yes, David, listen, thank you so much again for your time. It was greatly appreciated. Some very valuable insights, and I wish you all the best and good luck to all your clients
Thank you.
that you have to deal with, for sure.
And thank you very much for having me on today. It was a real pleasure.
My pleasure as well. All right. Thank you.
Take care.
Bye-bye.
Bye now.